Welcome back to the deep dive. Today, we're cutting through all the noise. We're taking your stack of source material and really drilling down to what matters.
And our subject is the very high stakes world of finance.
That's right. Specifically, we're dissecting the full year 2025 earnings results and the big strategic presentation from, well, an industry behemoth, Morgan Stanley.
And that presentation, it lays out a really clear thesis. They titled it, "The Integrated Firm Executing on a Higher Plane."
So our sources for you today are exactly that. The detailed earnings release from January 15th, 2026, and that CEO roadmap presentation.
Right.
And our mission for you, the learner, is to get beyond just the headlines. By the end of this, you'll understand their 4 strategic pillars, what a metric like ROTCE really means, and crucially, how they plan to grow that massive wealth management business.
And we really have to start with the headline numbers. They set the whole tone for the year. This wasn't just a good year, it was a record setter.
Okay, so hit us with it.
Full year net revenues, they soared to $70.6 billion.
Wow.
And just to give you some perspective on that, that's a huge jump from $61.8 billion the year before.
And that leverage shows up on the bottom line, right? The earnings per share, the EPS, hit $10.21.
Up from $7.95 in 2024. I mean, those are the kinds of numbers that signal a real transformation, not just, a good market cycle.
Right. It's not just a cyclical bounce.
Exactly. So when they talk about executing on a higher plane, they are fundamentally talking about a new level of structural profitability. And in this world, there are 2 benchmarks that really matter.
Okay.
We just mentioned one, earnings per share. The other is return on average tangible common equity, ROTCE.
ROTCE, right. And for anyone who's not a CFO, that's a critical figure. It basically measures how well the firm is using shareholder money to make a profit.
It tells you if they're doing more with less.
Mm.
And their ROTCE for 2025, it wasn't just good. It was,
Transformational.
that's the word. It hit 21.6%.
Which is a big jump from 18.8% in 2024.
A huge jump. For a firm this size, getting an ROTCE over 20% is a really powerful signal. It puts them in an elite tier. It suggests their strategy is what's working, not just luck.
And I think the history really seals that argument. If
Yeah.
you look at their average EPS from, say, 2016 to 2020, it was about $4.47.
Okay.
Now, you look at the last 5 years, 2021 to 2025, the average jumps to $7.50. You don't make that kind of leap by accident.
It's the proof for their whole higher plane strategy. And they organize that strategy around 4 pillars.
Which are?
Strategy, culture, financial strength, and growth. And they all have numerical goals tied to them.
Okay, let's get into those firm-wide goals because the sources show they're already ahead on the big ones. They're aiming for a 20% ROTCE,
Which is the beat.
a 30% pre-tax margin in wealth management, over $10 trillion in client assets, and a 70% efficiency ratio.
And they absolutely crushed 2 of those goals in 2025. We know that 21.6% ROTCE beat the target, but the efficiency ratio is where you really see the cost control.
And just to clarify for everyone, the efficiency ratio, that's how much it costs the firm to make $1 in revenue. So lower is better, right?
Precisely. They were targeting 70%. In 2025, they delivered 68%.
That 2-point difference might sound small, but at this scale,
It's huge. It demonstrates immense operating leverage. That efficiency is really baked into their operations now.
and that strength, it comes from their capital base, which is rock solid. Their CET1 ratio, it stood at 15% at the end of the year.
Which is about 320 basis points above what's required. It's a huge capital buffer.
And that gives them flexibility.
For sure, both for regulators and for shareholders. They used that strength to buy back $4.6 billion in stock during 2025. And the dividend is a healthy $1 per share. The foundation is stable.
Okay, foundation established. Now let's pivot to the growth engine, the part that's really defining their future. Wealth management. This is where that integration idea really pays off.
Record results here, no question. The wealth management segment pulled in $31.8 billion in revenue. That's a 12% jump year over year.
And what's fascinating is watching them hit their targets in real time. That firm-wide goal of a 30% pre-tax margin for wealth management.
Yeah.
They almost hit it for the full year at 29.3%. But, and here's the key point from the sources, Q4 actually surpassed it. They hit 31.4%.
So they're proving that 30% isn't just a goal, it's sustainable.
Exactly.
And that profitability, it's all powered by just unprecedented asset gathering. Total client assets are now at $9.3 trillion.
9.3. They are getting so close to that $10 trillion goal.
They really are. And think about this. In 2025 alone, they added $356 billion in net new assets. And $160 billion of that was in fee-based flows. That's just staggering momentum.
And it's not random. It's totally driven by what they call the integrated client funnel, which is kind of the genius of their strategy.
It's a calculated strategy of access. I mean, they're dramatically expanding the number of people they have a relationship with.
How much?
Core client relationships jumped from an average of around 60 million to about 100 million in 2025. That is 40 million new relationships in 1 year.
And those relationships, they mostly come from those acquisitions, right? E-Trade and the workplace platforms, they're like feeder systems.
They are high-quality feeder systems.
Yeah.
So you start with a corporate stock plan or maybe a self-directed trading account, and then the firm just moves you up the value chain to a full-service advisor.
And the numbers back this up.
The numbers validate the whole thesis. Advisor-led flows, which is the highest value business, come from workplace and E-Trade, were around $100 billion in 2025.
$100 billion. And what was it before?
The average in the 4 years before was about $60 billion. So this strategy is clearly, demonstrably working.
Okay, so here's where it gets really interesting if you're trying to look ahead. You study their roadmap, and they're not just waiting around for the market. They're targeting specific high-fee product areas.
Absolutely. The future growth isn't just about gathering more stocks and bonds. It's about expanding into areas where, high net worth clients need sophisticated solutions.
Like what?
Alternatives, private markets, tax-efficient investing, and notably crypto and tokenization.
That last one is a pretty big signal, isn't it?
It's a huge signal about where they see future client demand. And they're also pushing things like family office services, outsourced CIO, tailored lending, services designed to lock in their wealthiest clients.
So that massive growth engine needs fuel. And that fuel, it comes from the investment bank. So let's shift to the Institutional Securities Group, ISG, because 2025 was a spectacular year there, too.
Yeah, even with the usual market volatility, ISG posted record net revenues, $33.1 billion for the full year.
What was the main driver behind that?
It was really two things. First, investment banking revenues shot up 23% for the year.
And that's M&A activity?
Mostly. A big rebound in completed M&A deals, plus a lot of equity underwriting, so IPOs, convertibles, and debt underwriting. And that M&A rebound really picked up in the fourth quarter. It was up 47% compared to Q4 of 2024.
That signals a pretty healthy pipeline then.
A very healthy pipeline.
Sure.
The other driver was equity trading,
Right.
which also set a record, up 28%. And this wasn't driven by speculation. It was driven by financing revenues from higher client balances in prime brokerage.
Which is the service they provide to hedge funds.
Exactly. More client activity, more fees.
Fixed income, though, that seems to be where the volatility still lives.
It does. I mean, revenues were up 4% for the full year, but that kind of masked some softness later on. Q4 revenues were actually down 9%.
Why was that?
Lower client activity in things like commodities and foreign exchange. So, while the full year was strong, it's a segment they always have to manage carefully.
This brings me back to efficiency. A common critique of big banks is that growth always requires more risk. But your sources point to a key metric. Something about revenue growth versus risk-weighted assets running at about 2 times. Can you unpack that?
Yeah, that's a critical point. It basically means they are generating way more revenue for every dollar of balance sheet they have to use.
So they're not just chasing growth by taking on more risk.
Not at all. They're growing the top line much faster than the capital they need to hold against it. It proves that 68% efficiency ratio we talked about is from smart scaling, not just, crude cost cutting.
Although the cost cutting was real, and it's important for the listener to know they addressed personnel pretty early in the year to hit that number.
That's right. In the first quarter, they took a $144 million severance charge. It was tied to a reduction in force, affecting about 2% of the global workforce.
And management said it was mostly performance-based.
Right. Driven by performance management and just aligning the workforce. It was a tough move, but it was a key reason they delivered that superior 68% efficiency ratio.
And this is obviously a global firm. We focus on the U.S., but they operate in 42 countries with, 30,000 employees outside the States?
And that global scale is paying off. Since 2023, regional revenue growth has been huge. Asia's up roughly 50%, EMEA around 40%, and the Americas up about 30.
So the integrated firm model travels well.
It does.
Okay, let's bring in the third piece of this puzzle, investment management. The asset management arm. It's the smallest, but it's growing strategically.
Yep, record revenues here too, $6.5 billion, up 11% year over year. Assets under management, AUM, reached almost $1.9 trillion.
And the strategy here seems very specific. They're doubling down on high-fee products like parametric and diversified alternatives.
It's the perfect synergy, isn't it? Wealth management clients are demanding access to these complex products.
And investment management is scaling up to provide them.
Exactly. The investable capital in just alternatives and parametric strategies, it grew from around $355 billion in 2020 to about $685 billion in 2025.
So they've nearly doubled that capacity in 5 years.
Which is crucial. Those products command higher fees, and they are essential for keeping those high net worth clients happy.
So let's synthesize this. When we talk about the integrated firm, how do these three divisions, ISG, wealth management, and investment management, how do they actually connect across a client's life?
It's a continuous loop. It's a great model. The firm gets a client early through its MS at work platforms, managing cap tables, 401ks for employees.
And then that relationship moves into wealth management when those same employees need advice.
Right, or when they need liquidity. Then that successful private company often goes public, and that's where institutional securities comes in to execute the IPO. That generates huge fees for the bank and a massive wealth event for the founders.
So it's a cradle-to-grave system. They help you unlock liquidity with private shares trading. They help you grow with financing. They help you preserve wealth with a family office.
And invest for the future. It's the ultimate goal of the integrated model. And 2025 was the year they proved this model is not just a theory, it's highly effective.
So here's the core takeaway for you, the learner. 2025 was a record year for this firm, defined by elite financial returns, that 21.6% ROTCE, an amazing efficiency. And it's all driven by the success of their integrated model, especially those massive inflows into wealth management, which is getting so close to that $10 trillion asset mark.
And here's the final provocative thought for you to take away. The firm has built incredible momentum with traditional moves. But that roadmap, it explicitly targets aggressive future products. Given the specific mention of crypto and tokenization, how quickly will mass adoption in these new areas give them the final push they need to blow past that $10 trillion goal? That's the growth factor to watch.
That's the knowledge nugget to take with you. Thank you for sharing your sources with us for this deep dive. We'll see you next time.